Let's talk Shake Shack. From its humble beginnings as a hot dog cart back in 2001 in New York City to the 650 brick and mortar locations that exist at the end of 2025, Shake Shack is a perfect example of a small business success story, one that movies are made out of. However, unlike in the movies where you have a happy ending, that's not going to be the case here for Shake Shack. Shake Shack is now having to deal with big boy problems that publicly traded companies have to endure. In this episode, I'm going to provide at least six different valuation outcomes for Shake Shack. None of those outcomes are going to exceed $10 per share in valuation. During the research of all of this, what I've learned and discovered is that Shake Shack is not following the industry standard model for fast food restaurants. And this is wreaking havoc on their financials. And in turn, this is creating volatility with the market price. And on the screen, I'm illustrating that volatility for you. You can see since it went public back at the end of 2014 when it had 63 restaurants to where it has 650 today, you can see the market price fluctuation changes over this time frame of 11 and a quarter years. You can forgive this particular time frame here because this is due to COVID, but give you a good example of volatility here in June of 2022, the market price was $40 a share. In February of 2024, a little bit about 20 months later, it's now $107 a share. Now, during this time frame, the financially speaking, the company only improved by $1 per share annually. Unfortunately, folks, that doesn't justify a greater than $60 improvement in the market price. First, I want everyone to know two things. Number one, I have never owned a position with Shake Shack. Furthermore, it is unlikely I will own a position with Shake Shack in the next 10 years, as I consider this particular security too risky, and you'll see that in this episode. Thus, I have nothing to gain from the information I present to you. Number two, pretty much every analytical result I present will be dramatically negative against the current market price. Given this, I will say that Shake Shack has a good burger. I've had the chance to sample one at an airport eatery and thought it was pretty good. It didn't compare to a Five Guys burger, but given the price comparison, I would rank it as a top 10 hamburger of the 70 or so different burgers I've tried in my lifetime. Thus, good burger. Oh my gosh, ugly financials. So let's dig in. This is episode 2 in the fast food series. Episode 1 covered the standard bearer, and for those of you wanting to understand the ideal business model for this industry, I urge you to watch that episode. I refer to the standard business model frequently in this series. My name is Dave, and I'm a value investor. I firmly believe that good information, compiled properly and evaluated, will allow for an investor to make good decisions. I've been an accountant for over 33 years, and I have a graduate degree in this profession. I've read several thousand financial reports and prepared several thousand tax returns in my lifetime. In this episode, my goal is to convey three key points for an investor to understand what Shake Shack is truly worth in comparison to its current market price. Number one, Shake Shack is using the lowest level core tier business model for the fast food industry, and that is not the best model to use. Second, part of that is that they have an economy of scale issue, which means that they really need to hit about 2,000 locations. Currently, they're at 650 in order to stabilize their earnings and be resistive against an economic recession or negative consumer sentiment well into the future. The second point I want to make is that right now, the current earnings that Shake Shack has only warrants about a 10 to 1 market price. If Shake Shack does not change its business model, there's no way that you should, as an investor, consider any type of PE ratio greater than a 12 or even a 14 to 1, which is the industry standard for fast food operations. The last point that I want to make, number 3, is that if you compare Shake Shack to Wendy's, and I know that Wendy's is much larger, but you'll see that Wendy's number of company-owned locations is comparable to Shake Shack, and yet Wendy's, because they're using the more modern-day business models, is able to withstand economic turmoil and negative consumer sentiment to a great extent and still continue making profits. In order to do this, there are three spreadsheets that I have prepared for you. These are additional notes, some business metrics, and so on. The first one I have up here is the analysis of the summary data for the last 11 years for Shake Shack. You can download that. You'll see the revenue for each year. You'll see the profitability for each year. You'll see the cash flow that exists for the company. And this is critical to understand this summary data in order to truly grasp uh, Shake Shack's financial condition. The second thing is I have some business metrics in here. These are some like key performance indicators, some standards that exist out there. It's important for you as an investor to understand some of the issues that Shake Shack has on its financials in order to be successful. They're going to have to address many different financial metrics in order to keep moving this company forward. Lastly, the third one that I have is the alternate valuation models. I'm going to actually cover one of them in this episode, but I do have two others there that you can take a look at, and it'll help you to grasp what Shake Shack is really, really worth. This is, if of all three, this is the one that you really should look at in detail. And uh, so I suggest that you download these. Go to the website valueinvestingnow.com. You can pull these up, download those, have those spreadsheets. You can use them throughout this episode to read or refer to as I discuss them. The first promise I made to you is that I'm going to explain to you is that Shake Shack is not utilizing the best business model for the fast food industry. In order to do this, as an investor, you first realize that our economy is divided into sectors, and then one of those sectors is called food service. And within the food service sector, there are several different industries. One of those industries is called the informal eating out, commonly referred to as fast food. Within the fast food industry, there's three key business models that they use, and I show them here on the screen. The first one, which is the old traditional model that existed back in the 50s and 60s, well into the 70s, which are company-owned locations. And what that means is that the company actually owns the land, owns the building, owns all the equipment. They run the stores directly. And so forth. And traditionally and historically, those that operated these underneath the most optimum conditions performed very, very well. They had maximum profits of about 13% after taxes, interest, taxes, and so on. And again, this is assuming some strong gross profit margins at each location. And of course, the corporate office operated appropriately. So here, underneath of this situation, optimum price to earnings ratio for a model that's really heavily reliant on company-owned locations is about 12 to 1. Now, to give you an idea, Shake Shack has 650 restaurants. 373 of them are company-owned locations. So just not quite 60% of their portfolio is company-owned locations. The next model that exists out there within the fast food industry is called franchising. This is what the average person out there really understands is what's happening with the fast food industry. So you got a corporate office, they have a brand, whether it's like Burger King, Popeyes, whatever it is, and they franchise out their brand. And what that means is an individual gets a license, uses the brand, opens up their own location, complies with the rules and so on, and pays a fee to the mother company for the use of its brand. And this is called franchising. So the franchisee pays the franchisor money, a royalty of some sort, to use that brand name. Here, what ends up happening at the corporate level, because they're not actually operating these locations, but they're just getting a cut of the revenue at the top, and they don't have to deal with any of the other costs after that. Generally, this improves profitability to like 23% after taxes. Again, good margins and optimal practice at the corporate level. Now, many of these types of entities have a combination of company-owned locations and franchising. As an example, Chipotle uses this model. They have some locations that are company-owned and franchised out locations. And so you can get a really good, a much improved bottom line profit. To give you an idea, McDonald's used this concept of company owned and franchising through about the year 2009, 2010. And consistently, McDonald's was able to show net profits after taxes of about 20 to 21% during that time frame when they were really running this model to the best potential that it had at that point. Here, optimum price to earning ratios are about 17 to 1, because what this model does is it allows greater profitability, improvement in stability of the earnings, the consistency goes up with earnings, and they're more resilient against economic downturn or negative consumer sentiment as it relates to fast food or a particular brand. What has happened over the last 15 years is some of the fast food organizations or companies that are out there have moved on to a new type of a model, which includes ownership of land. When not Wendy's. Wendy's is doing this, but McDonald's has taken this to the next level. Here, what ends up happening is the McDonald's is the landlord, and what they're doing is they're finding the optimum site to locate a restaurant. And in turn, what they do is they lease that restaurant out to a franchisee. So the franchisee is not only paying a 4%, McDonald's is a 4% royalty. In addition, that franchisee is also paying rent to McDonald's for the use of that site. The cost associated with those rents is very, very low. It's like about 30 cents on the dollar. So there's a tremendous amount of contribution margin coming in for rents. And McDonald's is about 40% of their total gross revenue comes from rents alone. This allows them to up this maximum net profits. It elevates them to the next tier, which is in the 30% range. So McDonald's has been able to consistently get 30% plus over the last 5 years as it relates to using this particular model. This model is not utilized by Shake Shack at all. So in reality, Shake Shack's maximum net profits, because they're using mostly company owned and some franchising, is probably around 15% is going to be their maximum net profits in the future. And in order to go beyond that, they're going to have to update their model with what's going on. To show you this, Shake Shack's current model, you can see it right here. Company-owned locations are 50%, and they're all the domestic restaurants. They're all here in the U.S. They have some domestic franchises. There's like 40, almost 50 of them are domestic, so there's about 8% of them. And the remaining balance are foreign licenses where they're collecting a royalty off of those using the name in other countries. There's a problem with the foreign licenses that, you do have extreme risk due to some of the legal challenges and political environment that exists in other countries in comparison to the United States. Now, I want to compare these two models of what Shake Shack has against the industry standard bearer, which happens to be McDonald's. So, let's exercise a 5% decrease in revenue related to the sale of the food products in these locations. What's going to happen to each one? Well, with McDonald's, The company-owned restaurants, the value will impact the bottom line about 76 million. For royalties, it'll be about 240 million dollars in reduction in royalties. So basically, with McDonald's, they had in 2025, they'll report about $8.6 billion as the final net profit. If in 2026, everything stays the same except that there's, like, let's say, a recession, and there's a 5% drop in sales during that recession, then McDonald's will experience about a $300 million decrease. Notice that nothing changes with the rents, which is the highest contribution margin in their portfolio. But royalties and company-owned restaurant net profits will go down. So overall, about a little over $300 million. So now the profit drops to 8.3 billion, and this is a 3.7% decrease in overall profitability for McDonald's. So what's happening here is McDonald's business model is very resilient against change that happens out there in the economy. With Shake Shack, the math is much more punitive. Here with Shake Shack, given what's happening right now, company-owned sales would actually impact the bottom line by 14.5 million, licensing by 2.1 million. So in 2025, net profit is estimated at 52 million. They're going to report here in about 3 weeks, and I expect it to be $52 million net profit for the year 2025. And if we went with a 5% decrease in 2026, this will end up at a $35 million net profit. If everything else stays the same, that's where we should be. This is a 32% decrease in profitability, whereas McDonald's only has a 4% decrease in profitability. Same economic situation, 5% decrease in sales, yet look at the difference between the two of them. And this is strictly related to the business model that Shake Shack is using in comparison to the standard bearer, which is McDonald's. Now, I'm going to take this one step further. In 2025, I want to show you here Wendy's. Wendy's experienced a 3.5% decrease in its sales in the year 2025. Wendy's reported last week for the year 2025, and I want to show you something here that kind of reinforces what I'm trying to convey to you. Number one is that their net profit in 2024 was basically $200 million. You can see it. I've highlighted it here in yellow. So what happened is when it's all said and done, Wendy's made $200 million in 2024. Sales go down 3.5%. Wendy's is going through some problems. They've recognized those problems. They've implemented some solutions. They are making changes, and Wendy's does use the more modern day model. Wendy's does go out and find land. Then it goes through the process of leasing that land and building to a franchisee to use for purposes of generating revenue for the corporate office itself. So in 2025, with a decrease of 3.5% in sales overall, profitability only went down $35 million. So it went from $200 million down to $165 million. Technically, it's $30 million because it's 195 to 165. So it's $30 million is what it went down. So you can see, because Wendy's is using the more modern day business model where there's a very strong portfolio of franchisees, and they're also acting as a landlord. They have many, many sites, like $230 million was generated just from rents during the year 2025 for Wendy's. So you can see a very strong portion of their entire revenue stream is coming from using that particular model. Of the 7,200 locations for Wendy's, 6,000 of them are in the United States. So they have like a portfolio of almost 80% of their portfolio is US based operations and 20% are foreign based operations. Whereas with Shake Shack, it's only about 60% is domestic and 40% is out throughout the rest of the globe. So there's a big difference between the business models that exist between Shake Shack, Wendy's, and McDonald's. And this is critical to their financial success because it makes it very difficult to be successful when using an antiquated business model. And I'm going to show you something here that's kind of interesting. I stated earlier that Shake Shack needs to get some economy of scale going in here. Right now, they're at 650 restaurants. So, what would happen if they went to 2,000 restaurants? It'll take them about 10 years to get there underneath of their current model. So you have 2,000 restaurants, 1,200 of them will be company owned, and 800 will be licensed. Many of these will be in foreign countries. So the profit and loss statement will look like this. It'll end up with a net profit of about 175 million. 176 million technically. So earnings per share would be about $4 per share. So if they are capable of hitting 2,000 restaurants using this particular business model, they would probably, because they have economies of scale, could warrant a 14-to-1 PE ratio. So you would take this $4 multiplied by 14, and you get basically $56 per share is what it's worth. But that's 10 years from now. Not today. They're only at 650 restaurants today. But 10 years from now, this is where they could be worth about $60 a share. Again, 10 years from now. Now let's take this particular P&L. Let's see what happens 10 years from now if there's a 5% decrease in the recession. Are they resilient against change in the economy? And the answer is yes, they are. The profitability drops to 135 million when it's all said and done because there's a decrease in 5% in sales at the company level, and with licensing, of course, the costs associated with running the company-owned restaurants does decrease, but depreciation, G&A doesn't change, and so forth. So the final bottom line is it drops to $3 per share. So you can see a 5% decline in sales with 2,000 restaurants reduces earnings by about 23%. And I showed you with Wendy's, they had a decrease in earnings of 3.5%, and that only affected the bottom line about 15% overall. And that is because Wendy's is using the more modern day business model, and Wendy's has the economy of scale related to the volume of restaurants out there, so they can be very resistant against change overall. Now it's time to discuss the construction of these additional restaurants that Shake Shack is trying to reach in order to, one, reach that economies of scale situation that I've talked about, and then number two, trying to shift their model ultimately in the future if they're going to go this route to the industry standard of leasing land, building the buildings, owning the land, building the buildings, and then, of course, renting them out. Now, first thing here is this is the balance sheet for Shake Shack at the end of September in 2025. So when they completed their third quarter, they reported their information. This will get updated here in about 3 or 4 weeks at the end of February. For the entire year of 2025, lifetime to date. So basically, in order to go out and build these 373, remember 650 restaurants totals, 373 of them are owned by the company. So this reflects the ownership of these restaurants right here. So you have $598 million in property, plant, and equipment. But this is net of accumulated depreciation of 529. So basically, they've got about $1.1 billion invested. Almost $1.2 billion invested into these 373 restaurants. It costs Shake Shack about $3.2 million to get a restaurant up and running that they're going to own themselves. Remember, they don't own the land, they don't own the physical building itself, but they do own all of the equipment inside, all of the fixtures, including light fixtures, the electronic equipment, the sales, point of sale equipment, and so forth. So that is the $1.2 billion dollars that has been spent, $3.2 million dollars per restaurant lifetime to date. In addition, they commit themselves to a lease of here you can see $468 million dollars in leases, and they record this as an asset. However, there's an offset of a liability down below. I'm going to show that to you right now. So you can see down here the long-term operating leases are 540 million dollars. That's what they owe to the folks that have leased out this property to them and the building itself, but they have recorded as an asset 468 million. This $70 million difference between the two reflects prepaid requirements, and of course the contingencies in case they default on a particular lease. They have to pay a termination fee of some sort, and that difference reflects this. You owe 540, but you only have 468 million dollars of value at the end of the day. So that's what that is. However, this is the line right here. See this long-term debt? The company has gone out and borrowed $250 million in the interim to cover this $598 million of property, plant, and equipment. In the aggregate, what Shake Shack is doing is they're going out and about I think the math is like two-thirds of the money is coming from debt to put up a new restaurant, and a third is coming from their equity down in here, this 500 in $9 million, which is Shake Shack equity. So Shake Shack is taking their profits and reinvesting into new Shake Shacks out there, which is a good way of conducting business. The problem is in order to add another 800 restaurants, now I'm just talking about 800 company-owned restaurants, in order to get to the point where you have some type of economy of scale, because you currently only have 373 and you're going to add 800, you're going to have to borrow $2.5 billion. And remember, in my example that I gave, I said they've only borrowed 1.75 billion. But here we're talking about they're going to have to borrow an additional 2.5 billion just to add 800 more company restaurants into their portfolio to be at around 1,200 company-owned restaurants with about 800 licensed restaurants. So this particular model is very expensive to do. Whereas if you look at McDonald's model says, hey, we own 2,000 of the restaurants of the 44,000, and 42,000 of these restaurants are owned or financed by the franchisees. So you can see there's a big difference here in terms of generating how you go about expanding and growing a company like this. The company is highly dependent on its internal ability to make a profit to grow these restaurants. And the reality is, it just doesn't make enough profit to grow that fast. It's going to have to borrow more money. And in order to hit the true economy scales, break even point, to get to 2,000 restaurants where you have 1,200 of them, or at least company owned, and then the balance are franchisees, you're talking about 2.5 billion to get to that. So when you combine all of this together, you get a very um, risky setting. It becomes very debt intensive, and so that impacts the ability to give a good ranking or it impacts the ability to state that this investment is stabilizing, and that's number one. And of course, is the risk factor is going down when you have that large amount of debt and you lack the economies of scale. It's very difficult to say that this is a good investment from the get-go, which would warrant a strong, what we call price to earnings ratio for this particular investment. The price to earnings ratio reflects what a current investor is paying for a particular investment based on its earnings. This particular uh, model, this price to earnings ratio, this PE ratio, is very common, is commonly used in the investment world. And again, it only reflects the current trading price. And so, it's important to understand that the current trading price reflects lots of elements, underlying elements of a company before you can actually say what's fair and what's not fair. For an investor, you want to pay as little as possible for an investment. So a low price to earnings ratio reflects that concept right there. Now, I'll give you an idea. McDonald's is, I believe, right around in the 22 to 25 range at any given time. But however, with McDonald's, I want you to recognize the fact that they're highly stable, they're very large operation. They're a Dow company. They have low risk as it relates to even their debt service issues is very low risk. They pay a significant portion of their earnings out as dividends, and their growth is mostly funded through their franchisees and the expansion through the franchising system that they have out there. Shake Shack is different. So there's no way it's ever going to warrant a 20 greater than 20 to 1 price to earnings ratio. And I'm actually going to illustrate something for you that's going to surprise you quite a bit. So if you'll look here where row 10, now this is the sheet that I have available. If you go down into the description for this particular video, there is a PDF download that you can generate. It comes off of the website valueinvestingnow.com. And what it does is when you download it, you'll get a PDF and you can bring it up on your screen or you can print it out for your own review. But I have it here up on the screen. So row 10 reflects the net profits from Shake Shack over the last 13 years. Now, what's interesting is the company converted over to the existing legal format back at the end of September in 2014. So basically, it has recorded 11 full years of investment or financial information through the third quarter of 2025. In about 2 weeks, it'll report the fourth quarter and as a full year for the year 2025. Through that third quarter, okay, over the last 11 full years as a publicly traded entity, it has earned $41 million. Now, process this just a little bit. It has earned $41 million. There's 44 million shares outstanding. That means it has earned less than $1 per share over 11 years. 11 years. So that is just horrible. I mean, it's really not very good at all. And you can see that in here where they've lost money in certain years. Naturally, COVID came into that impact with the $42 million loss in 2020. They finally have 3 years in a row, 23, 24, and 25, where they're going to make, where they've made profits 3 years in a row. Now, when you consider calculating a price to earnings ratio, a reasonable investor will take at least 5 years of earnings. You can weight those years. The most recent year, you would weight it stronger than you would the earnings from 5 years ago. And you come up with a value, and then you divide that by 5, and boom, you've got an average earnings per year over the last 5 years. So with Shake Shack, this value is 64 cents. So let me, I'm going to click over here. And on the screen, I'm going to illustrate now my second promise that I made to you, which is, what's a fair and reasonable PE ratio for Shake Shack? Now, in the industry, for the fast food industry, it is really about 14 to 1. This is where you have the cutoff point. A reasonable investor will pay about 14 to 1 for a share of stock for something in the fast food industry. Now, McDonald's is much higher. They're into the 22 to 25 range. What you want to do is to be able to buy that stock, depending on what type of investor you are, when the price is much lower. But if it ever hits 14 to 1, oh my gosh, you should be buying McDonald's stock, because I mean it's an extremely stable company. I mean, without a doubt. And I've illustrated that to you not only in this lesson, but in the prior lesson. You can go in and you can watch that particular episode about McDonald's. Now, what this means is when you have a 14 to 1, you're considering all the various elements of ability to earn net profits. A rational investor, 14 to 1. What comes into play with this? Well, you've got consistency with the net profits. You've got the ability to have stable earnings. There's the size of the company. Now, 650 stores is what Shake Shack has. So they are not large at all. I mean, Chipotle is like 4,000 restaurants. McDonald's is 44,000. You have Starbucks with like 38,000, I think. No, they might even be at 40,000 now. Then there's the business model. You know, McDonald's has set that standard for the business model. Wendy's is trying to move into that business model and get set in that particular, converting over to the more modern model. Shake Shack is not in anywhere close to that. You have industry standards, and of course, McDonald's really sets those standards, and of course, risk. And I even highlighted a really interesting statement in their notes for McDonald's, where we talk about risk and how their cash flow is so strong that their risk factor is so low. It's incredible to see that. So all of this comes into play when you're talking about a price to earnings ratio. So if you look at Shake Shack's weighted average of earnings over the last 5 years, it would be about 58 cents. If you kind of discount the COVID situation that occurred back in 2020, you really move it up to like 64 cents per year. So if Shake Shack was a reasonable fast food chain, you'd have a weighted average of 14 on that. And if you did that, you'd have 14 times 64 cents per year. You get $9 a share. All right, so that's at 14. So is it worth $9 per share? I'm going to go through some of this as I continue doing this. This baseline of 14 is adjusted downward due to the business model, increased risk, and size. Shake Shack is nowhere near the minimum required level of number of restaurants in order to reduce risk and to generate economies of scale. So a more accurate PE multiplier is 10. And for value investors like myself, 8 would probably be the more realistic price to earnings ratio for a company like Shake Shack. I wouldn't even give it consideration until it hit that. So even at a 10, we're talking about $6.40 per share, 64 cents times 10, $6.40 a share. So the price would have to drop to that. Now, currently in the market, it's running between $80 and $90 a share. So you can see it is way overpriced, not only by the industry standard, but there's a lot of other elements, size, the business model that they're conducting, the risk factor associated with their debt service. They're going to have to pay a higher interest rate for their debt service to continue growing. None of this warrants greater than a 14 to 1 business ratio, PE ratio at this point. Okay. The third download link that I have down in this description brings you to a spreadsheet of 3 different models related to valuing Shake Shack. The first model right here is a organized liquidation of the company, i.e. each location is allocated its share of the licensing revenue and so forth. I use a column called impact factors in here. That means, say that we have the absolute best conditions at a perfect 1 in terms of sales volume at 3.9. Remember, each store is really at around 3.6, $3.7 million per year. profit margin is a 23%. They're really like 22.8. We have a multiplicative factor of 5 as it relates to the licensing revenue, i.e., you're selling this opportunity for licensing revenue. What would you get for it? You'd probably get 5 times the current valuation. That's really, really strong overall. A more realistic number would be in the 3 to 4 range. And then we get a value per store location, and then we multiply that by what they call a multiplicative factor. It's the discretionary income small business model multiplier. A perfect 3 here in this situation brings us to each store of about 2 million. Each store would get its allocated share of assets and leases, and then of course it would be assigned its share of overall liabilities, netting into a particular value of $1.9 million per restaurant. There are 370 restaurants, so the company is worth about 692 million, call it 700 million, 44 million shares, so each share is worth about $16 each. And this is when all of the factors are optimized. I mean, they're in perfect alignment, which is unusual and rare. The second thing I would tell you is that for a fast food restaurant to sell for 1.9 million less a associated revenue assigned to licensing, so we're talking about 1.4 million dollars for a fast food restaurant, and as a single location, a buyer would just simply say no, that's an unrealistic high price. A more realistic price would be in the $750,000 to $900,000 range per location. So you can see this number at 1.9 million, which again includes the licensing revenue valuation, is very, very high. And so the overall value for Shake Shack at $700 million, again, is very, very high. If you change the impact factors to more realistic values, let's say it's 0.22 for the gross profit margin, a more realistic 4 for the multiplier on the licensing revenue, and with the small business model, really a 2.4 is considered almost normal, I guess, under the best conditions. And you can see the share price drops to $8.50 a share is what it's really worth at a localized per store multiplier. The second model that I provide to you is looking forward to the next 10 years of earnings based underneath of different types of conditions. So underneath of the absolute best conditions out there, I created a little schedule out here for you. Underneath of the absolute best conditions, I call it liberal considerations, we're talking $34 a share. With more reasonable conditions, the price drops quite a bit. If you have a strong recession, it drops to about $16.25. If you give conservative considerations, i.e., they can only borrow their money in the 7% range, for example, for borrowing money, which is more realistic for a small cap company like Shake Shack. The only reason it's a mid cap right now is because the market price is so high. Capitalization is based off of market valuation. More realistically, this company is a small cap. It might even be, and for some folks, still what we call a penny stock, to be quite honest with you. So under conservative considerations, it's worth about $12.50 a share. I calculated intrinsic value at $10 a share. Value investors want a strong margin of safety, given the risk for this particular investment, at $6.25 a share. So really overall, it's very high price at 33. It's more realistic in the 12.50 range, looking forward for the next 10 years, assuming that it's going to make its money over the next 10 years. The last model that I present to you is called the market value comparison. And here I'm comparing it to Wendy's. Basically, Wendy's is currently selling at less than $8 per share. Shake Shack is selling at in the $80 to $90 range. Shake Shack has at the end of 2024, they had 329 company-owned restaurants. Wendy's had 381. Wendy's is selling at this much lower price, Wendy's makes money every single year, 16 years in a row. Shake Shack has only just completed its third year in a row of actually making profits. The net profit margin for Wendy's is currently 11%. For Shake Shack, it's 12%. Wendy's uses the much better higher tier model, as I've explained throughout this episode, and Shake Shack is more dependent on the company owned locations. Even if Shake Shack converts over to or begins moving towards the franchising model with a more serious percentage in its portfolio, where it should be in the 70-80% portfolio of its portfolio should be in the licensing realm. With that, it should move into a PE ratio of 14 right now, because it's so dependent on the company owned stores to generate its profits at the end of the day. A more realistic PE ratio is 10, which warrants only $11.40 per share of valuation. Currently, the book value is about $11.50, so you can see that Shake Shack is really not a good investment at the end of the day, given the current market price that's out there. Your better bet is to buy Wendy's, because you have a greater upside potential, much greater upside potential with Wendy's. And actually, I'm going to talk about that in the episode 3, where that particular episode will be about Wendy's itself. So at this point, I'm going to go ahead. I find business fascinating, especially on the investment side. One of the things I've learned over my lifetime is that when businesses don't follow the rules out there, they tend to fail, or they tend to perform poorly financially. And Shake Shack is not following the rules. The rule in this industry is simple and straightforward. You must have the more modern day rental based uh, organization, and you must be shift towards buying your land, having that real estate as a function of your portfolio, and utilizing that properly. You got to find good spots and so forth. Secondly, I doubt that Shake Shack is really going to get much bigger than 2,000 to 3,000 restaurants, only because there's not a market for the type of product at that price out there. I mean, let's be realistic here. I consider myself a hamburger connoisseur. I love them. But the reality is, I'm not going to sit here and pay 30% more for a product that's just marginally tastes better. Don't get me wrong, it's a great tasting burger and I would love to have it all the time. But I want it at a price like Wendy's, where it's $10 for the meal, where I get, my fries and my drink. But that's just not going to happen with Shake Shack. They are catering to a more higher standard, higher class type of a consumer. And in turn, there's only so many of them out there. So you can't justify having 3,000 restaurants. Something's going to have to change. So they're not following the rules. So the value should be adjusted accordingly. And so in here, I talk about this quite a bit. I'm going to rehash what we've talked about throughout this episode. Underneath of the most optimum conditions, where interest rate for their debt is at 5%. Realistically, it's going to be 7%. This is a small company. They're not going to get there. They're not going to be able to borrow money for less than 7%. If sales go to $3.8 million per location in terms of today's dollars, again, that's very tough to do. You're going to have to get to 2,000 restaurants. You got linear growth. There's no consumers. There's no negative consumer sentiment. Let's be practical here. Chipotle had that incident back in 2017, where they had a breakout due to their lettuce. McDonald's experienced it in 2025 when their onions on their double cheeseburger had a problem. They quickly, identified it and corrected it. So here, underneath of all the best considerations whatsoever, you could have a ratio of 14, which is the industry standard. The per share earnings would be about 239 on average, so it's worth, let's say, 33.46. So that to me is at the upper end. Everything's perfect. there's nothing wrong with this company. That's going to be unrealistic. So if you take 10 years of earnings with reasonable conditions, no recession, 24, 25. If you take current earnings, multiplied by that 14, you get a 1596. Again, I don't think they warrant a price to earnings ratio of 14. You can have a full liquidation with optimum factors like I illustrated or that you have as the printout at 1564. Current book value is 1150. Market valuation comparison to Wendy's is probably closer to 1140. Intrinsic value at 10. If you just do the weighted average baseline of net earnings at a 14 to 1, you got 896. At 10 to 1, which is really what is warranted with Shake Shack, $6.40, and if you're a value investor, $6.25. So overall, what I'm trying to say to you is that because Shake Shack is not following that model, and because Shake Shack is still has a long ways to go to get to develop their earnings, or I should say, economies of scale, and in turn, without shifting towards a franchising model, even the mid-level type of model that is used in this industry, Shake Shack's share price, there's no way it should go that high. Now, some of you are going to ask, well, okay, if the price is high, why don't I short the stock? And the answer is because typically, what's happening here is this organization has about 40%, not quite 50% of it is held by 10 institutional investors. So the reality is that this price isn't going to come down because these institutional investors are really going to do whatever they can to augment that price. They're going to buy whenever the price starts to drop. So it's just going to stay high for a long, long time. And you're going to pay borrowing costs to borrow stock in order to short it in the market. And the reality is it's just going to take a long, long, long time. It's going to take another 5 to 7 years before reality sets in and the market price begins that slow decline down into a more realistic range where you're getting down into the 20s. And then what's going to happen is somebody's just going to say, hey, this model that Shake Shack has, if we change the model, why don't we just buy the whole organization, change the model to a more realistic model, and then reissue it as a public organization and make our money that way? And that's what's going to happen when this price drops into the 30s and into the 20s. So the reality is you as an investor, you just basically want to ignore Shake Shack. The whole goal here was to illustrate to you how they're not complying to the business model, how important that business model is in the fast food industry, and where it really benefits you at the end of the day. Everyone, I do appreciate your time. I want to say one thing right up front, and that is good information provides opportunities for investors. And when you act on that knowledge, that's how you're going to improve your overall wealth. Please make comments, let me know, subscribe. Also, quite honestly, hit that subscription button because it tells me that you would like to see more of these.